Welcome, everybody. Appreciate you spending some time with us this afternoon. My name is Locke Olson. I'm VP of Enterprise Sales here at YCharts. Very excited to be joined by Mr. Nick Maggiulli to cover transforming data into dollars. Nick, I'll let you intro yourself here quickly.
Yeah, so I'm the Chief Operating Officer at Ritholtz Wealth Management. I'm also, a blogger out of Dollars and Data. Some of you have heard of before. And I've written a book, Just Keep Buying, and we'll be talking about all that stuff and a little bit more today. So, yeah, take it away, Locke.
Awesome. I do want to get in a quick disclaimer up front. First of all, please keep in mind that the content of this webinar is meant for educational purposes only, not intended to be used as investment advice, nor is YCharts acting as an advising party regarding client funds in any way. I would also like to point out that a recording of this webinar will be shared around after the event tomorrow. It'll also be available as a replay on our YouTube channel. Please remember to like and subscribe on that YouTube channel so that you can check out all of our future content. Why don't I go through the agenda here, and then I can pass it off to you for the first section here, Nick. So we're going to cover the market's evolution and some emerging trends. We're going to cover some of the biggest challenges that advisors and investors are facing in 2024. We'll then touch on what's top of mind for YCharts clients, users of YCharts, advisors, how they can solve problems and answer questions in the platform. And then I'll also share kind of a sneak peek of YCharts' roadmap and some of the key themes that are driving our innovation in 2024 and beyond. And then at the end, we will hit on some Q&A. Feel free to drop your questions in the Q&A section within the Zoom webinar, and we might touch some of them in the middle of the session here, but we'll cover anything we miss at the end. So without further ado, Nick, I will pass it over to you. Let's jump into some of the charts that you put together for us to talk about the market's evolution.
Yeah, so a couple things that have happened in the last few years. I want to touch on those today. I think two big themes I want to talk about. The first is just staying invested, and there's been a lot of stuff that's happened over the last few years, and we're going to get into that. And the second thing is investing with and without yield. So those are the two big things, is like staying invested for the long haul, and then, a changing yield environment. So this first slide here, this was borrowed, we'll say, from my colleague Michael Batnick, who says there's always a reason to sell, and he came up with this kind of chart idea a long time ago, and you can now implement this in YCharts, which is kind of cool, where you just show like there's always a reason to sell or get out of the market, or there's always a bear case, and at any point in time you can come up with a compelling bear case, and they all sound reasonable at every point in time. Throughout this chart, you can go back to this one, goes back to like 1990. You could have found a reason to get out of markets, right? And I actually think this is kind of ironic. I was born in November '89, and this chart goes from October '89. So basically, since my birthday, since I was born, the S&P 500 has returned 2,700% on a total return basis with reinvested dividends, and that's to translate, every dollar you put in would become $28 today. Of course, that's not adjusting for inflation, but still, it's a 28x return in roughly 34 years. So it's a 10% annualized return, which is pretty good, right? And if you probably with inflation, if I had to guess, it's something like maybe 7% real. Obviously, I don't expect that going forward forever for the S&P 500. It has done that over basically the last century, and if it does that again, that's great. I try to predict 4 to 5% real returns, but we'll kind of see what happens. But the point of this chart is like, especially in the last decade, and actually maybe the last 5 years, we've seen a lot more volatility. Obviously, COVID was one of these moments, and then in 2022, volatility's back. And I think telling your clients to stay invested is such an important topic that like it's this idea was kind of like dying off, and now it's starting to come back in a big way. So if we go to the next slide, this will just one really good example of this. Like in March 2020. At the bottom during COVID, March 23rd in particular, 2020, COVID basically wiped out 3 years of gains. All of the gains in 2017, 2018, and 2019 got wiped out in the course of a month, right? And so this index value basically got back to where it was in like late 2016 in the course of, a month, right? And so obviously a lot of people are very scared. I've heard of people who had clients that moved to cash or were really wanting to get out, and we had to talk people off the ledge. Like we've had personal experiences with this at our firm and stuff like that. And I'm guessing you probably did as well. And so, but what was the lesson here? Like, yes, people are freaking out, but if you had stayed invested, you would have been rewarded, right? And so that's kind of the main takeaway. So if you go to the next slide, you'll see like this is, once again, we're starting at the exact same point that we started at before. And so we were just showing those first 3 years, and then this is everything that's happened since, right? And so that's kind of the long, the long and short of it is like, over the long haul, like staying invested does benefit investors. Of course, this is not true in every market all the time, but a diversified portfolio should do well in the long run, right? And so it's just reminding clients of this because, as I said, 2020 was tough and 2022 was extremely tough for a host of other reasons. So kind of those two themes is like, hey, look, market's back. We're basically, I think today we might hit all-time highs, at least on the price side. So we'll see. We're gonna kind of see how that goes, but we're getting close again, once again. So the next big theme, as I said, is talking about yield, and so investing in a with and without yield. So for most of the 2010s, as many of us know, like bonds weren't really paying much, right? So like because of that, a lot of people ended up going more risk on with their assets. So I remember like the big topic or the big theme of the 2010s is 80/20 is the new 60/40 because 60/40 was the 40 wasn't paying enough, right? And so because the 40 wasn't paying, we were in a low to no yield environment. Everyone put risk on. Well, obviously 2022, 2023, yields went up a lot. And now as a result of that, like 60/40 is kind of back in some ways. The 40, for example, is back. And so because of that, now retirees are happy to like, hey, look, I can actually earn money, with little to no risk through bonds and treasury bills and whatnot. And so what's amazing about that is that that's kind of a big transition. That's been a big transition in the last few years. And now with the Fed talking about cutting rates again, the question is like, are yields going to drop off, and are we going to go back to a low yield environment? We're going to go back to one of those environments where we have to go back to risk on. And so this is still, obviously, if I'm trying to predict it as much as anyone else, no one really knows the future. We're all guessing. I think right now I saw a chart from Charlie Biblio or I'm sorry, Bileo, and he was plotting the expectations of the yield curve going forward, and they think like I think by 2025, yields will be under 4%, right, a year. So that's kind of where they're seeing things go. The Fed fund rate is going to be under 4% by then. So we will see what happens. I think we're kind of just waiting to see at this point. So that's kind of the main thing with yields, but also not just like yields are changing and what are we going to do in a low yield environment or a high yield environment? No one knows, but it's also a very odd yield environment. So if we go to the next slide, what this is showing, and I actually kind of like this functionality in YCharts because this is showing the 10-year treasury minus the 2-year treasury, right? And so most of the time this is positive and it makes sense, right? If you're, letting the government borrow money over a longer period of time, usually you get compensated for that. So the 10-year treasury yield is above the 2-year, which is why this orange line is usually positive. But every once in a while it inverts. That's the inversion. And so most of the time you can see after the yield curve inverts and it starts to uninvert, that's when you see the recession, which is all those, vertical gray bars. Now, what's interesting is you can see the most recent data, the yield curve inverted and we still haven't had our recession, right? And so is that going to happen in this year? Is it going to happen next year? Who knows? Are we going to skip the recession altogether? This is still debated. Everyone thought the recession was coming in 2023 and it didn't happen. So it's just one of these things where if you start thinking about, what's happening in markets and we're kind of in, it's very cliche to say unprecedented times, but it is a little bit unprecedented to have the yield curve inverted for this long and no sort of recession or anything like that. So those are kind of the big themes of kind of what's been happening over the last few years, right? Like, you want to stay invested. That's a key theme. And then, what's going on with yield. But I think going forward, I mean, there's some similarities to that, but things are going to change a little bit. So if we go to the next slide, I think it's a couple different challenges for 2024. The first one I want to talk about is persistent inflation. Obviously, this shows inflation going back to, I think 1915 or something, or 1914. And obviously you can see like inflation, from basically 2000 onward was pretty much below the average, especially in the 2010s. It's probably the lowest maybe it's ever been, except maybe after 1960. The lowest it's been on record. And then obviously we've had a lot of inflation in the last few years. And inflation has been coming down, which is great, but I don't think it's going away yet. I really don't. I don't think we're going back to 2% anytime soon. Does that mean I think we're going to 9%? No, but I think it can be a little bit stickier than people think. And, the latest inflation data, what's actually causing inflation, it's shelter, it's rents, things like that are still increasing over time. And so across the United States. So I think if there's something to worry about the next few years, I mean, people are talking about, I mean, everyone knows it. You probably have stories, anecdotes, people, they're talking about like, yeah, I had to pay, I went to Chipotle and it was $14 for a bowl. This used to be $9, right? Whatever it is, like everyone has a story of like, this is crazy, this pricing. And so whether it's food, whether it's rent, whatever it is, and we're seeing pricing go up, and I don't think it's going away anytime soon. And I think it will keep increasing. The question is the rate, and it's anyone's game, right? So the next big thing, and I've already kind of touched on this a little bit, is, declining yields, right? Yields have gone up a lot in 2022, 2023. And now the question is like, what's going to happen to yields going forward with the Fed's considering to start the pause and then the cuts, right? And so you already see the market has started to react to this in the last few months, but this is the question of the next year. It's like, I mean, I'm even thinking about like my personal money. Do I lock in like, oh, I want to get this yield and just lock it in for the next 5 or 10 years, especially if you know you have a fixed payment you have to make in the future. Like there's a lot of things that your clients are going to be thinking about as well. Is like, do we lock in on a 10 year at 4%, or do we wait and see? And like maybe it won't drop, maybe it will. And so there's all sorts of questions around yields right now. And so if you're thinking about the future and thinking about clients and how you can provide, good advisory services, like everything's about yields. And I'm not asking you to make forecasts about the future. That's too difficult, but just keep this in mind because this is going to affect of all the things that impact people and what they do, like yields and rates are probably the biggest one, right? Because it determines if people can borrow money. And if they can't borrow money, it changes if they want to buy a house. I mean, there's all sorts of impacts throughout the economy. So if the Fed really does start to cut and it starts to go down further, that's going to really impact a lot of things. And so it'll be interesting to see how this plays out. Um, and then the last kind of topic I want to talk about here is not really related to investing and stuff, but it's more about like what's going on in the advisory space. And so right now, because we're kind of coming out of this, 2022 was a really rough year. And then, 2023, we kind of had this recovery. And now there's kind of like this sense of like a new bull market, like Bitcoin ETF just got approved. Bitcoin's like kind of going back up. There's a lot of stuff that's happening that's like really kind of getting people interested in investing again. I think there's a lot more attention on money. And so anytime that happens, people start to make changes. Like we're already seeing internally, at my firm, leads are coming in more. Like a lot of stuff that's happening is like we're starting to see it across the industry, and it all moves at once, right? So as this shows, like, more than 1 in 5 people have switched advisors since 2020, and roughly 25% are considering switching, right? So like I think obviously this data is a little bit older. I think these numbers are probably going up in the next year, right? Anytime there's these big cataclysmic shifts of like attention and stuff, when people are talking about markets, money, things like that, they start to reconsider, yeah, should I be working with this person? Should I have this advisor? And so if you're out there and you're prospecting, this might be a good time, right? So, make sure you're communicating with clients, make sure you're kind of you're staying proactive there, and you're also, being proactive to get new clients. So that's kind of one of these, one of the things to look out for in 2024 and beyond, is because anytime there's these big changes in what's going on in markets, whether you want to call this a new bull market, I don't know if I would say that yet, but we're on the cusp of what sounds like a new bull market. If those things start to play out in real time, then I think you're going to see, a lot of this type of activity. So, and I'd be interested to hear from people, or if anyone has questions regarding that, to see if they've already starting to see that or not. That's just from my anecdotal evidence. Obviously, this is very limited. I'm starting to see some of these advisor client, trends starting to shift in a different direction, which I think is generally good for the industry, but it's something to keep in mind. So, Block, you want to take it from here?
Yeah, I did see a question come in, Nick, that was kind of
Mhm.
tied to the inflation slide. So I wanted to bounce that off you and see if you had any thoughts. It came in saying, is there a correlation between inflation and pricing? It seems like even if inflation is down, companies are reluctant to reduce prices, a la Chipotle.
Yeah, so I don't actually know the answer. That's a great question of like how sticky prices tend to be sticky, especially it's like for something like, oh, well, once you set the price, like they'll just leave it there. I mean, is in theory, an efficient market is supposed to be moving prices all the time. In theory, every day Chipotle's burrito would be different, but like the price of a burrito bowl would be different, but that's not how it works, right? They set a price and that's just kind of what it is, and it stays there. And unless sales take a big enough a hit, then they drop prices. But because of, how our economy works in the sense of we kind of target inflation, like I can't remember a time where prices dropped on any sort of like consumer good where it's like, oh, it's dropping over time. Like I don't the only ones I can think of are like televisions and things like that, but most food has like been flat. Funny story. My grandmother grew up I'm sorry, my mother grew up in West Covina, California, so my grandmother lives. And there used to be a pizza place called 3.99 Pizza, and you could get a whole pizza. And when I was born, it was there, 3.99 pizza, an entire pizza for 3.99. They have finally, after 33 years, have changed the name of the pizza because they cannot afford to give you an entire larger pizza for $4. So it just goes to show that it gets everyone eventually. So yeah, that's a great question on pricing. I don't expect Chipotle or Starbucks or anyone to lower prices, even if inflation slows. I think we're not going to, I doubt we're going to have deflation. That would be a very, I can't imagine that scenario. I'm not saying it's impossible, but we haven't had that in a long time. And for something like that to happen, I think your Starbucks or your Chipotle are going to be the least of your worries. So,
Yeah, that was quite a deal, 3.99 pizza. The only
oh yeah.
interesting thing I could point to or think about maybe is housing. And really the only time you see housing prices come down is some kind of extremely dramatic, you know, shift in the market. So usually
Yeah.
those
And
prices
that's a
appreciate
very
these too.
different good, right? We're talking, house prices. I think that is far more likely to see those come down, or at least maybe don't not going up as much. Then again, it hasn't really happened. I mean, they've come down in some markets a little bit. Like we've seen San Francisco prices come down, but but the rest of the country hasn't. You start looking at local markets, you'll see some decreases and people cutting the price they're listing for. But I haven't seen this at least anecdotally. I'm like on Twitter and stuff. I haven't seen enough of this in the rest of the country. So maybe the higher end's coming down, but the rest of the country, I haven't seen anything like that.
Right. Awesome. Thanks, Nick. Well, so much of what you were talking about there leads to kind of an interesting thought about, how are advisors communicating these pretty complicated concepts, right, to their end clients, and how could they use YCharts or some of the tools that we've developed in YCharts over the years to better either illustrate these concepts or just get their clients up to speed on kind of how they're thinking about what's moving markets, how they're investing their portfolios, how they're allocating dollars. So I wanted to kind of jump off of some questions that either we're hearing often in conversations with advisors, or Nick, you proposed a couple of these, but I've got some kind of pre-built things in YCharts here. Nick, as I'm jumping through any of these examples, if you have anything that you want me to like double click on or pivot to, happy to move around in the system too. But the first one here was, how would your portfolio have performed historically? We get this question a lot. An advisor wants to be able to explain to a prospect maybe that's coming over, or if they're considering changes to a portfolio, hey, how would that have done historically? You can show this a number of different ways in YCharts. I took the opportunity just to build it out in a fundamental chart, and I wanted to show in this not only the portfolio itself, which is this balanced model portfolio here, kind of depicted in the red line. And I have it benchmarked against a 50-50 blended benchmark, which is kind of that green or teal line. I also compared it to just the S&P 500, the blue here, and the Bloomberg US aggregate, which is just the fixed income benchmark, just for comparison's sake, right? To show a full equity portfolio, full bond portfolio, and then kind of a balanced portfolio right there in the middle. I think the good story here, maybe if you're the advisor of this balanced model, is hey, long-term performance outperformed by benchmark. That's great. But I think what you can also really, in a compelling way, visualize in a tool like YCharts is some of these drawdown scenarios and the volatility that you might experience the more equity you take on in a portfolio, or at least the opportunity to capture some of the returns of equities without taking on all of the risk of an all equity portfolio by having that balanced model. I did also throw on the 10-year treasury rate here because a lot of advisors will like to kind of overlay not only those performance and risk concepts with what's going on in the market. What are kind of those themes that underpin what's moving these portfolios and the securities in them and driving that performance, as you were just talking about, Nick, right? So as treasury rates rises and falls, how does that impact the performance of a portfolio? And how did this portfolio hold up the last time interest rates were maybe falling over a certain period of time or kind of spiking recently?
Yeah, and the thing I like about this, I know you create these portfolios, you use custom securities so you could load in your composite data. For example, we use Orion so we can get the composites of our portfolio performance, take that, monthly data, load it in here, and then have a model portfolio that actually uses our composites, and then we compare that to whatever, as long as for over whatever time period we have, which makes it really nice. So, yeah, that's one thing you can do, yeah, among others. So.
Absolutely. The one other thing I'd toggle here is this percent off high view is really popular just for looking at kind of what kind of drawdown could a prospect or client stomach. I don't have them drawn on here right now, but you can actually kind of pin these lows on the chart and call them out so that you can really kind of speak to, hey, the S&P 500 was down maybe 33%, it looks like, compared to 13 or 14% in my balanced portfolio. Helps someone kind of conceptualize their risk appetite, I think, in a scenario like that.
Yeah, and I think we've actually been for the data junkies like me, we've been very fortunate since 2020 because, up till I would say from 2012 to 20 to late 2019, we had a couple, late 2018, you can think of 2015, 2016, we had a couple little drawdowns, but they weren't that serious. But now that we have, March 2020, and then we have everything that happened in 2022, we have two, which I think are very different market environments to compare performance. And even just looking at this chart you have up here with the percentage off high, you can see, March 2022, basically the riskier the asset, the more it declined generally. So they're kind of in lockstep with their riskiness, which makes sense. But then you go and look at what happened in 2022. And now that it's not just in lockstep with the riskiness, because that's a very different market environment. So it's good to see both, like, hey, obviously when everything's crashing, right? That's good to see just in its own right, to see like how do drawdowns generally happen during panics. But then even during kind of more chaotic environments, which I think like 2022 was, with high inflation, with yields changing, that's actually a very different environment that we wouldn't have had data on previously. So I think this is also what's useful with doing these kind of comparisons.
Awesome. So I'm going to jump into the next question here, which is, how do I build a report to compare my proposed allocations to my client's current allocations? And I tried to tee up an example here that maybe plays on some of the concepts you were talking about earlier and how those might play out in the portfolio construction process as you're explaining to a prospect or client either risk on or risk off, or kind of how their portfolio is allocated. So I built out a report using our report builder tool that goes through a number of different kind of data points and concepts. I definitely wanted to call out the talking points feature, which is a pretty new addition to YCharts, though. And it allows you to embed within the report some talking points, things that you want to hit on or kind of key up in that conversation to explain. Again, these are difficult concepts for me to understand for sure, right? Being able to explain to just your clients is really important so that they kind of grasp the work that you're doing that goes into that portfolio construction process. So I built a few here kind of in the beginning that we'll hit on later. But this again is another way to look at historical performance, right? So how did my portfolio do during certain time periods? You could certainly do that in a report. And then getting into some of the stress testing capabilities, you can look at this data on the website. This is a new module for our report suite. It's been really well received. It's a great way to get an idea of, how did my portfolio do the last time inflation was spiking, or when there was sustained volatility, or the last time interest rates were hiked back in 2013. So lots of different kind of scenarios. You can even customize these and kind of cherry pick the scenarios that you would like to analyze and understand kind of how that portfolio would have performed. And then getting into the allocation piece, again, touching on the talking points and kind of the proposal concept here. If my prospect's current portfolio is maybe, let's call it a 70-30, and based on the conversations I've had with them, their risk tolerance, their time horizon goals, it's my understanding that they need to take a little risk off the table, and I'm proposing a balanced 50-50 portfolio. I get an opportunity here using these talking points to really kind of explain to the prospect or client the thought process, the methodology, the why behind that change. And you can either use kind of pre-built text in here in the talking point, or you can actually drop in your own text so that you can really use your own words to explain these concepts. You can get a little bit more granular too, whether it's on kind of the equity side of that exposure, or I have a fixed income component in here too, right? Maybe you want to speak to the maturity of the portfolio, or at least the bond positions in the portfolio, right? You could actually call that out in a talking point and explain kind of why maturity is important, how to think about the maturity, how to think about maybe the changes that you're making in the duration of the assets that you're purchasing on the fixed income side. Nick, anything jumping out at you here that's either relevant or coming up in conversations a lot with clients and prospects?
I mean, yeah, when I look at this, I put on my COO hat, which is like, hey, like we want to make sure, like if we're sending out proposals, that like all we're selecting what we want to show to the prospects. We don't want people just going adding whatever they want. We kind of want to say, hey, here's the options you can talk about, and then the advisors can then pick and choose kind of what they want to put in there, right? And so I think that's helpful from like a compliance perspective. It's helpful from like guiding the conversations, and if you have a certain investment philosophy that your firm puts forward, like you want to be able to have kind of control that narrative a bit. And of course, you also want to allow it to be custom because every advisor is different. So I think this tool allows for that, where they can say, oh, actually, I don't want to talk about duration. Like some advisors would love to talk about duration, others would not. And it depends on the prospect. It depends on the advisor. I mean, there's a lot of different variables here. So keep that in mind as the customization. Like you don't see that here because we just you created this, but I'm saying you all of these pieces can be taken in or put out as you see fit, right? Exactly. So just something to keep in mind. And I think when I'm thinking about like as you're trying to scale a business, you kind of need that customization and being able to kind of swap things in and out. So that's kind of what I'm thinking about when I'm looking at this thing more than like any particular thing about this portfolio.
Yeah,
So
that's great. You mentioned personalization, and I feel like that's been in articles in the news lately a lot is personalization of advice. And I think this tool is a really interesting way to, like you just said, do that at scale because you can come in here to the report builder suite, customize what you want advisors seeing and reporting on in those conversations with prospects and clients, and get it to a point where it can be personalized and tweaked, but they're all using kind of preset examples that you're comfortable with.
yeah, because every prospect's going to be different. Like certain prospect, if you have someone who's an 80-year-old retiree, that you're going to tell a very different story and talk about very different things and show different talking points than if you're talking to someone who's 35 years old, software engineer at a FANG type company, right? So it's like just knowing, I think everyone knows that as an advisor, that, and it's like the ability to pick and choose and allow your advisors to kind of tell the story they want to tell, I think is what really makes it useful, right? Versus having like a standard deck that you go through with every single person, right? When you do that, that's great and all, but the problem is you have to like skip stuff, and it just, it's much easier when it's like, wow, I made this report just for you. It's completely customized to this interaction. I think it comes across a little bit more personalized. So
Absolutely. Absolutely. All right. The next question was, how can I incorporate economic charts and data into a YCharts dashboard? Uh, in a number of ways. You can do it with the data itself. You can do it with visual charts. I pulled up this macro dashboard that I've had on my account for a while. This is an extremely kind of fluid, customizable drag and drop environment, right? You can add modules very easily if I wanted to add a different chart. I think I have in my library here an example of that 10-2 spread. Yeah, here we go, that you were talking about earlier, Nick. So really quick and simple to add these charts to your account. You can either add charts that you've previously built in the fundamental charting tool and save down to your account, or that chart I just grabbed there is one that was just shared with me. There's a lot of default charts or charts from webinars like this one that get loaded up and shared out to all of our YCharts user base. Anything that you're kind of keeping a close eye on, maybe other than things we've touched on earlier in the presentation here, Nick, that folks
yeah,
should think about adding to their dashboard?
to be honest, I try not to look at economic data like that. Like I will see it. I already see it coming through on Twitter and stuff. So I don't go out of my way to add extra. Like I don't want to get bogged down in all of that. Remember, I'm trying to do a very long-term approach and just kind of how I view things. I don't think economic data is useless, but I also don't like want to obsess over it because like there's only so much we can do anyways, right? It's like, is your approach set up regardless of the economic environment or even within a guardrail of like, hey, if the economic environment's between here and here, we're okay, then that's kind of how I like to invest and how I like to view things. So obviously, I would change allocations and make minor shifts based on things changing in the markets. For example, yields. If yields were to keep rising, that would change maybe how much fixed income I put my new money into versus not, exactly, etc. So just stuff like that. I don't really track it like that, but this is really helpful for those that like to track certain things, or if a client that's tracking a certain investment, it's good to know, just kind of keep yourself, abreast of what's going on.
Yeah, absolutely. I should call out too, you can set alerts on these indicators. So if you wanted to be notified if the 10-year went above 4%, or if the 10-2 treasury spread went below zero and inverted, you could set it up in your account so that you get an email from YCharts when that triggers.
Yeah, I think we've found that this has been helpful when someone has like a concentrated position and we're like, hey, if it gets above some trigger level, we want to sell down, 5% of that asset or vice versa, So it's like thinking about those types of things and how do we get out of these concentrated positions. That's one way of doing it. If we're doing it manually, there are obviously more sophisticated ways of doing it through, algorithms and stuff like that. You'd like direct indexing, you can kind of put in a concentrated position, but this is a little bit more, if you don't want to go the more advanced route and you got to do it yourself, this is a way to do it with the alerts.
Absolutely. All right, this last one had my financial planner hat on. And Nick, I'll probably lean on you a little bit here once I explain kind of what I built out to maybe say how you can use concepts like this in conversations with your clients. So the question was, let me jump back here, it was I'm thinking about selling an investment property and putting that money into the market. Should I invest that now in one lump sum, or should I invest it over time? So I used our scenario builder tool to build out two competing scenarios. One is I took $100,000 out of that investment property and I just dropped it right into the market in one fell swoop, and that's the orange line here. The other is I set up a recurring contribution, depositing $1,000 a month for I think it was 8.5 years until you get rid of the entire $100,000, and you can kind of see those contributions visualized at the bottom over here.
Mhm.
But ultimately showing that the maybe the right decision is to invest that lump sum at once. I thought it was a good illustration of time in the market versus timing the market. But the other thing I can show here, and Nick, I'll let you kind of chime in with what you think about when you see some of these concepts, is you can show within two standard deviations kind of what the probabilities are. And this is looking out into the future, I should add. So this is kind of starting with I deposited this money today or started to, and then looking out through the end date of 2044. So basically going 20 years out from now.
Yeah, so it's very cool that you can kind of like I like the orange band, as you would expect, is much wider because like
Quite wide.
obviously, you know,
Yeah.
S&P can go through a very rough period over the next few decades, and if it does, you know, obviously putting money in slowly would have been the better choice. So yeah, I mean, it's just interesting that, you know, you can kind of come up with different scenarios, put money in it in any sort of way, and you kind of do some basic financial planning, you know, if you're like looking at something in particular, trying to make a particular point to a client. Because a lot of times, you know, this stuff is not necessarily that intuitive. And so having these tools just makes it really easy for you to kind of make a certain type of point. Like, hey, actually, here's why you should maybe put it all in now, but maybe we should cut down on the risk. If you're really that worried about a market crash, like maybe we need to reconsider your overall investment strategy and just put this money into a more balanced portfolio instead. That's like one way you could do this.
That's a great point. I should call out, you can choose which security you're showing here, right? I chose SPY, the S&P 500, just as an example, but you could definitely show that balance model that we were looking at or any of your strategies as well.
Okay, yeah. Someone asked, how do you propose a portfolio that includes alternative investments that may have a limited historical track record? And I think so. If you have, I mean, we're going to talk about this a little bit, extending performance backwards, but I think if you do have some whatever data you do have, you can upload that in as a custom security. So that for sure, you can get that in there in a proposal or whatever. But then there are ways to extend that if necessary, right? So I think yeah, custom securities is where you're going to want to go to like put in alternative investment data, and you can name it whatever you want, and it'll be in there, and you can have it in a model portfolio and show like, hey, here's exactly how this would have performed over this time period. So
And maybe just to continue that thread, I'll show the performance proxy concept now since we're talking about it. If I pull up a portfolio and I go into edit the position, I need to turn on my advanced portfolio settings. I need to choose that I want to enter some performance proxies, and then I want to edit the items in my portfolio. Let's all pretend like IWM is some alternative strategy that's a custom security that I loaded up and it only has 3 or 5 years of history. If I want to add a performance proxy here, I would just go in and search for maybe it's a benchmark, maybe it's a different fund that has maybe a similar performance timeline or performance kind of profile, performance or risk profile, I guess, to that alternative security. You'd load that in and it would just track that history from there.
yeah, that's how you would backfill, like or approximate, you know, what the data or how the performance would
Yep.
have been, you know, before a certain time period, which can be helpful. So yeah, I mean that's the best. If you obviously don't have the data, like you have to kind of like basically guess, and that's what this is. It's performance proxy, which is kind of a newer thing. So
Yes.
hope that answers that question.
Thanks for calling that one out. All right, we had a few additional ones. How do I extend the history of a position in a model portfolio, which we just touched on, right? So that's that performance proxy concept, which is a really new feature in YCharts. It's something that our users have been asking for a really long time. You can see here, without using a performance proxy, you might have a portfolio that has one position in it that just doesn't have history for some reason. Maybe it's a recently IPO'd stock or something like that. You could now go into that portfolio, assign a proxy for it, maybe even just pin it to SPY or something like that, or some kind of like industry or sector benchmark, and then it'll carry back that performance, which is represented in the orange line there. So this is kind of walking you through the workflow that I just went through to pull up performance proxies using that advanced portfolio settings whenever you're editing a model portfolio. All right, the next question was, how can I construct a proposed client portfolio while maintaining a few legacy positions? And we just have this GIF kind of running in the background here that's showing you effectively what you do is you'd go in and select the portfolio that you want to kind of edit. and then just update the positions, go in and edit the positions, add in whatever portfolio holdings you need to kind of retain in your new model, and then go ahead and save the portfolio down. It's a really easy workflow. The other workflow I would call out that's somewhat similar to this is a lot of times people want to compare. Nick, maybe you're talking to a client and you've been working with them for 10 or 15 years now. They have a portfolio that you were comfortable with 10 or 15 years ago, but as time has gone on, maybe their risk appetite has changed. You need to make some adjustments to their stock or bond exposures. You could use YCharts to then duplicate that portfolio and make some of those changes and then compare in a comparison report like we looked at earlier. Hey, here's your current exposures. Here's what we're moving you towards, and here's why.
Yeah, I'm pretty sure if you look in the GIF here, I think when you click upload data, you can upload more than like instead of having to put them all in manually, right? There's a way to upload, I'm pretty sure, right?
There is, yeah. It really just
Yeah.
depends kind of on the workflow. You can
Mhm.
upload or pull in from an integration partner as well,
Okay,
right?
yeah. Because that would be, a lot of times someone may have not just one or two positions. You don't want to be typing in, 50 positions. So it might be a lot easier just to upload a file or something, or as you said, pull in from an integration partner. And it's like, wow, now I have that client or that prospect's portfolio in there and I can easily track it, right? And so if you can imagine having their name in YCharts and like, okay, I just look up their portfolio because this is literally what they're invested in over time, and it would just, have that data ready for you to present if needed.
Absolutely. All right, the next one is one of my favorite new tools. How do I reduce concentration risk in my portfolios or using the portfolio optimizer? We have a new tool in YCharts called Portfolio Optimizer. Not only does it help you optimize portfolios and allow you to visualize portfolios on an efficient frontier along with their holdings, but one of the coolest parts of it is this correlation matrix heat map, which you can kind of see part of in the background here, which gives you a really good idea of where you have concentrated positions. And usually concentration leads to maybe outsized risk. Nick, is this something, do you show correlation heat maps ever in conversations, or how do you think about avoiding correlation and outsized concentration?
I mean, the issue with core, I mean, I have nothing against heat maps. I actually think they're really helpful in certain circumstances. Like during good times, I think correlation heat maps are really useful. I think it's also good to like talk about like, hey, this is during like normal times what we expect going forward. Of course, when things go bad, everything tends to decline at once, right? So it's keeping that in mind. All the correlations quote go to one. So keeping that in mind. But yeah, I mean, this is if you have a client who's a little more technical, a little bit more wants to get into the weeds with you, this would be very helpful, right? I don't think it's necessary for most clients, but those that want to see this, and if you're like trying to push alternative, different types of investments, I think that's an area where this would really show up, right? Because for most people, it's like stock bond, but if you want to start adding other types of things to the portfolio, which has become more popular in recent years, I think this is a way to show that.
Yeah, and I think also just from a portfolio construction standpoint is where I hear about its use being pretty popular. If I have my portfolio manager hat on and I'm maybe designing the models for Ritholtz Wealth or something to that effect, right? Being able to look over longer time frames of the correlations of the different funds or securities that we're using in those models is a great use case for this tool. How did your proprietary strategy perform against the market? We already touched on custom securities, right? So you'd load up a custom security in YCharts, backfill that performance history, which just allows you to look at that proprietary strategy like any other security in our platform. So in the GIF here, it's visualizing in the fundamental charting tool and comparing it to the Dow Jones Real Estate Index in this case, because we've loaded up a private real estate investment fund. So great example of using custom securities like any other security on the platform to compare performance, conduct due diligence, see how it looks in the portfolio.
Yeah, I really love this because it really just says like, hey, you gotta use your own data and just use the YCharts ecosystem and use it however you want. You can run correlation with, I don't know, Bitcoin or this or that, like whatever you want to do, you can do it with as long as you bring the data, like you can now do everything as if it was like a ticker, like any other ticker, which is kind of nice. So
All right. And then this is calling out that stress testing feature that I mentioned earlier and the ability to add custom or additional periods that you want to stress test or visualize. So within our stress test tool, which is really just a tab whenever you're looking at a portfolio or a security on the website, you click into the stress test tab, which you can see kind of hidden up there, and then you add a custom time period. You can give that time period a name. they're entering the lost decade here, right? And then just curate that stress test that you want to see, drag and drop to put it in the position you want it. Now you can see in the upper left-hand corner there, that's kind of that first stress test that you see on that tab. So a great way to visualize kind of how portfolios or securities would have held up during different events or different time periods.
Yeah, I love this because, there's certain periods that you may want to highlight over others. And so, especially if you have like good historical data going back far enough, like if once again, that you can import any data into here. If you want to get Schiller's S&P data and throw it in there, you could put that in there. And now you have S&P data going back to 1870. So, or 1871. So it's one of those things where, yeah, it really allows you to kind of test all sorts of stuff as long as you have the data.
Absolutely. All right. Next, we're going to get into a little sneak peek behind the curtain of our roadmap. Some of the themes that are driving what we're building in 2024 and beyond. The first theme that I wanted to touch on is more asset classes. Nick, you've mentioned this a few times just in the last hour, right? People are talking a lot about alternatives. There are a lot of different types of alternatives. I think that's one of the most kind of compelling things from a YCharts perspective is not only, we obviously have the custom securities feature, but building out even more kind of capabilities around custom securities so that advisors like yourself can kind of speak to the importance of maybe embedding those in portfolios moving forward, or maybe talking about why they're not including them in portfolios as well.
Yeah, exactly. I mean, I think 2022 is a big wake up call for a lot of people because obviously, US stock, US bond, like that's been the traditional portfolio for so long. And in 2022, 60/40 got killed. Obviously, bonds and stocks, collapsed together. Inflation was high. It was just not a good year. And so I think this really did make people rethink their portfolios and saying, do we just want to have only stocks and only bonds? Do we want to consider anything else? Do we want to and so now that yields are back, this is kind of opening up some opportunities there, right? So I think it's great that you guys are building that out because I think there's going to be even more demand for this in the future as people try and kind of hedge these different types of risks.
Absolutely. Yeah, we're hearing it every day. So it's definitely top of mind. The next one is just seamless communication outputs, more ways to communicate with prospects and clients or within your own firm, within your own four walls between different teams, different groups of advisors. Um, I'm sure any company faces communication challenges, whether that's with their customers or internally. I think, Nick, from our perspective, you've seen tools come out from YCharts like Report Builder, like Talking Points. We've always had the charting tools. Now we have scenarios tools. We view these as kind of great ways to help an advisor explain and position their value proposition, kind of what they're bringing to the table for a client. And like we talked about earlier, just educate clients, right? Great client education tools, which are invaluable. What are your thoughts on just some of the, I guess, output capabilities that YCharts has come out with recently?
Yeah, I mean, I've been using YCharts since 2018. I can tell you back in 2018, 2019, you could not have done all the stuff and all the customization that you can do today and like present to a client. I said, hey, if I just took like YCharts, just screenshots and try to present something to a client, it just wouldn't hit in the same way that it could now because there's so much more depth there. There's so much more, customization, as I said. And so you guys are clearly shifting focus to, I mean, not just be like, hey, this is great for like individual retail traders and stuff like that, but you're like, hey, this is actually a place where you can use this information to communicate with clients. And so I can see the shift. I see you guys still putting more energy and resources into that. And I think it's great. I think it's the exact type of thing that, we need. So.
Yeah, I mean, our long-term view is that every advisor can benefit from being able to better communicate what they're doing for prospects and clients, whether they're building the strategy themselves or not, right? Maybe they work with a third party, or maybe someone in their home office is building the strategy that they're trying to explain. They still need to at least be conversant in what's going on behind the scenes to build and understand that actual portfolio. So you'll continue to see more from us on the proposals and the talking points front. We keep rolling out new features and new modules for the report builder functionality. That will continue. And then we're always thinking about how do we kind of streamline workflows too. Once we build something, we want to make it easier to implement or execute as an advisor. So be on the lookout for more there. The next segment here is increased portfolio capabilities. We've rolled out some pretty cool functionality in 2023, and there's more to come this year. If anyone on the session here today has had a chance to play around with some of our attribution capabilities, those are pretty slick, and something that our users have been asking for a long time. Nick, I don't know if you've had a chance to to poke around with some of the attribution tools yet, but have you seen those or and gotten any value out of them yet?
I actually have not had time to use it. I know that's like the newest thing you guys just came out with. I've looked at the optimizer though, which is kind of cool to like kind of have that capability because that's something that I've always, I've had to do manually or find some other tool to do it, right? And manually is not great because if you don't, yeah, I don't want to get into it right now. But yeah, so it's great you guys are building that out. I think that's going to keep continuing because people want more portfolio analytics. They want to understand where's the return coming from, where is it not coming from, et cetera. And it makes it easier to tell a story with a client, right? That's what attribution is all about. So yeah, that's kind of the main things I would touch on there.
Yeah, you spoke a minute too about being able to pull data into YCharts. And when I think about portfolios, that's kind of another key topic is those integrations. We're constantly seeking new integration partners or thinking about how we can enhance our existing integrations, make them even more functional for advisors than they are today. So be on the lookout for more innovation and integration on the portfolio side of the house. The last one is compliance, everyone's favorite subject. I'll spend a couple of minutes talking about kind of what we've done around the SEC marketing rule. It's been everyone's favorite topic since I think that November of 2022 when it went into effect. The headline is that YCharts is extremely customizable. You saw a little bit of a preview of the report builder tool. That is a tool that we can expose either to home offices or advisors to curate templates like we were talking about earlier that kind of suit the requirements of the firm. I think one thing we've seen is almost every firm has a different interpretation of the SEC marketing rule and is putting somewhat different rules in place for their advisors. And it might even come down to the type of client that they're serving in that interaction. So I think the best thing working in YChart's favor there and the way that we can support a lot of different firms is the tool is extremely customizable. The report templates are extremely customizable. We have a number of new features that we've rolled out that allow advisors to better comply with their firm's interpretation of the rule, whether that's providing more education upfront in the form of like a disclosure page at the start of a report template, whether that is, as we've been able to do for years now, showing performance net of fees and showing lots of standardized returns and some of the requirements outlined in the rule around fee disclosure, or just being able to set up either customized disclosures at the home office level or a new feature we have called dynamic disclosures, which basically look at any of the metrics included in a report, any of the modules, and then make sure that the right definitions and disclosures are just embedded in the report as soon as you run it, which is really cool and something that just came out recently. So we'll continue to do work here. It's kind of a moving target, but we will keep staying on top of the market and compliance concerns and making sure that folks can actually use a lot of the great visuals with prospects and clients.
Yeah, I touched on this a little bit earlier, but as I said, putting on thinking about how to scale, right? And saying like, hey, okay, this is great. If I'm just a solo advisor, like I don't have to worry about this as much as if, there's 20 advisors at my firm and I have to make sure they're all staying compliant, right? Because if you're just one person, you can kind of comply yourself, right? So, but yeah, so I think that's really helpful, like thinking about how to scale this thing and how to make it so, oh yeah, I have 20 advisors making proposals, I have this or that, et cetera. So all these types of things are just more enhancements for YCharts and allowing people to do the report builder and stuff like that. So I love that stuff. I love the dynamic disclosures. As I said, you don't want to see 10 pages of disclosures for every possible thing you can put in there if you didn't necessarily need all that, right? So just making
Amen.
sure that you're covered for what you've actually presented is useful.
Absolutely. All right, we will get in some Q&A now. I'm going to pull up some of the questions that have been coming in. Let's see what we've got here. We cleared out any that we had answered earlier, right?
Yeah, I think so.
Let's see, the first one, let me read this. Can YCharts show withdrawals from a portfolio and change them 1 year to another for an advisor to add value? Say withdraw large value in 2022 and large growth in 2023.
Pretty sure you guys could do that with scenarios, right? You'd have to put in different securities and showing like, hey, this security, this is what you did in this period, and then this security for this period. You have to do, I think you could do something like that. I'm not exactly sure because I'm trying to figure out what they're asking, but
The other thing I wonder here is if there's a dynamic model portfolios kind of piece here too, which we haven't touched on yet, but
Yeah,
dynamic
that'll be
model
easier.
portfolios allow you to upload historical changes that you've made to a portfolio. So we have two types of models you can build in our system, a static one, which is just current holdings and weights, or a dynamic model, which, if you have your transaction history going back over time, you can upload kind of day over day changes at that level of frequency if you needed to show changes made to a portfolio over time. And then you get a much better idea of the risk and return metrics tied to a portfolio. So that might be an option here if you built a dynamic model portfolio and then did a scenario, or as you said, Nick, I think we could probably build two competing scenarios and see what those look like side by side.
Yeah, actually, now that you say that, I actually agree that dynamic model portfolio is the way to go. You would just say, hey, in 2022, I'm going to have them invested in large value. In 2023, I'll have them invested in large growth. And then you would run a scenario where you're withdrawing some amount from the portfolio over time. Right. So if that's the case.
So the next one here was portfolio optimizer. When can we use this tool for dynamic portfolios? That is a great question, Mark. I will follow up with you offline because I don't know off the top of my head. Next one, any thoughts on how to incorporate forward-looking asset class expectations? For example, 2024's JP Morgan expected return, expected standard deviation, cross-asset correlations to inform a forward-looking portfolio optimizer. It's a great question. I don't want to speak for our product team necessarily, but when I ran that forward-looking scenario, it was using some CAPM assumptions. As of right now, we only have kind of our hard-coded CAPM assumptions. I think it's something that we've considered and might even be on our roadmap for next year, which I haven't seen yet, to allow firms to customize those CAPM expectations. So maybe just something to keep an eye out for in the future. Definitely not the first request we've heard to be able to customize those. And the last question I saw here was, how did you create the overlay chart? I'd like to chart the S&P 500 for the calendar year of 2021 and overlay it with calendar year 2023 as an example. That's really interesting. I might need to use our Excel plugin to pull that down and actually overlay those. You can definitely visualize both of those calendar year performances, but overlaying them in a chart, I don't know if you can do that in our fundamental charting tool. I think you'd have to do that actually in Excel. Nick, I know you spend a lot of time in fundamental charts. Maybe you know better than I do, but
Yeah, no, I don't know if you can do that. Like if you're doing overlays, like you want to say, okay, I want to show 2021, 2022, 2023, I usually just pull the data down and then do it in R, but that's like a programming thing. So
right.
yeah, because I don't know how you would, I mean, yeah, you would have to like append the data access. Or I guess what you could do, yeah, you can actually, I guess the simplest way to do it is you take the data from 2021 and 2023 and you create two separate custom securities and then you just, you like load in, that's how I would do it, right? You would just say the dates on those is like the same. You would just say they're both in 2023. You take the 2021 and you just put it you act as if every day is in 2023 and then you just map them next to each other. That's like probably the
That's a
simplest
great
way.
call. There you go.
Yeah, I would
That's
take
nice.
2021 and then just like change the dates and upload it as a custom security. You can call it like SPY 2021 in 2023, and then you would just load both of those next to each other, right? So I think that's the easiest way to do it. You just have to, the hard part is like mapping that because the dates aren't going to line up exactly. Like the third might be the fifth or something, like you get what I'm getting at, but that's how I
Yeah,
would do it if I did use YCharts. So it
that's a
takes a
great
little bit
idea.
of manual work, but you could still have it in YCharts and visualize it in YCharts. You wouldn't have to actually chart it in Excel. So you could have all your custom colors, whatever things you have in YCharts. You just need to change the data a little. So that's the thing, because there's so many tools here, like you don't even think of this stuff on the top of your head. You can probably do almost anything. You just have to be a little bit, inventive. Like, oh yeah, I can just do this and then it'll work, right? So keep that in mind.
I'm impressed that you came up with that on the fly. Very cool. I do want to mention before we wrap up here, there's a little blurb at the bottom. If you mentioned Nick Maggiulli, if you're not a YCharts subscriber yet, when you talk to anyone at the YCharts team, you can get 20% off a new subscription. So keep that in mind if you're not a current subscriber, although you all should be. Nick, any other thoughts as we wrap up here? It's been a pleasure. Thanks so much for joining us, and thanks to everybody for stopping by this afternoon and spending some time with us.
Yeah, thanks everyone for coming by. Appreciate it. Hope you all have a great 2024. It's been starting off good so far, so let's keep that momentum into the year. So hopefully a new bull market, new highs by pretty soon, let's hope. So
There we go. Well, awesome. Thanks so much, Nick.
thanks a lot. Appreciate it.